Kidneys act as your body's natural filtration system, constantly scrubbing toxins and excess fluid from your bloodstream. But when a patient reaches end-stage renal disease, that biological filtration system completely shuts down. To survive, patients must rely on dialysis. This is a mechanical process where a machine pumps the patient's blood through an artificial filter, cleans it, and safely returns it to the body. Missing a session is life-threatening, meaning this grueling cycle has to be repeated 2 to 3 times every single week. Because survival depends on it, the demand curve is perfectly recurring and recession-proof. It functions as a mandatory medical subscription that continues for the life of the patient. You would assume a guaranteed patient base is a goldmine for traditional hospitals. In reality, it is a financial nightmare. A standard dialysis ward requires a massive amount of overhead. The upfront capital outlay for the machines is steep. The technicians required to monitor them are highly specialized, and the procedure itself burns through a constant stream of expensive consumable materials, like the physical dialyzers used to filter the blood. Managing this complex supply chain requires intense, granular focus. Without it, the costs of wasted labor and discarded consumables rapidly compound, completely eroding any potential profit margin a hospital might have made. Hospitals find themselves trapped. They have to offer dialysis to support their broader nephrology departments, but they lack the scale to run the machines profitably. That operational blind spot created a massive vacuum for a specialized operator to step in. In 2010, an Indian company called Nephrocare realized the most efficient way to capture this market wasn't to build expensive new medical centers. Instead, they built an asset-light operating system designed to run inside the infrastructure that already existed. They call it the captive clinic model. Nephrocare takes over struggling dialysis wards, plugging in their own modular equipment. Under this revenue-sharing agreement, the hospital provides the real estate for free. Nephrocare runs operations and kicks back a percentage of earnings. Nephrocare secures an immediate stream of patient referrals with zero real estate investment. At the same time, the hospital gets to offer a high-quality, specialized service to their patients without having to manage the logistical headache. This exact same asset-light logic translates seamlessly to the public sector through public-private partnerships. State governments face a similar dilemma to private hospitals. They need to provide free or highly subsidized dialysis to vulnerable populations. But public health agencies rarely have the operational bandwidth to run these complex clinics efficiently. Through a formal partnership, the government provides the physical space inside district hospitals and medical colleges. Nephrocare brings the machinery, the staff, and the consumables. In return, the government pays them a fixed contractual reimbursement rate for every single treatment performed. This arrangement hands Nephrocare massive, immediate scale. They secure a steady, guaranteed inflow of beneficiaries across entire regions, all with an incredibly low upfront capital expenditure. But this raises an obvious question. How does Nephrocare actually make a profit on shared revenue and government-subsidized treatments when traditional hospitals fail? The answer lies in strict operational control. Nephrocare deployed a proprietary cloud-enabled system called Renova, which safely reprocesses those expensive dialysers. Reusing these filters cuts their consumable costs by 30 to 40% per cycle. They also solved the industry's biggest bottleneck, finding qualified staff. They bypassed the external talent shortage by building their own internal pipeline called NPIDIA Academy, offering a 24-month accredited diploma program to train their own specialized technicians. By manufacturing their own talent pool and engineering a highly efficient supply chain, Nephrocare built a proprietary operational moat that regional competitors simply cannot replicate. When you eliminate the need to buy real estate or construct buildings, the financial outcomes are striking. This asset-light approach drives a 22.8% return on capital employed, far outpacing the heavy infrastructure costs of a traditional hospital network. Because they require so little initial capital to launch a new clinic, the company operates almost entirely debt-free. They can fund their rapid expansion directly from the cash flow generated by their existing clinics. From an investment standpoint, Nephrocare doesn't behave like a traditional healthcare chain. With its high margins and low overhead, its financial profile closely mirrors a highly scalable tech platform. This chart shows Nephrocare taking its proven algorithm out of India. Notice the aggressive shift in revenue mix. By expanding into foreign markets with higher reimbursement rates, their international revenue contributions surged from 12 to 41%. They're deploying capital into rapid acquisitions across the Philippines and establishing massive public-private partnerships in Uzbekistan and securing new operating licenses in Saudi Arabia, targeting economies with rising disease burdens and expanding healthcare budgets. The success of NephroPlus relies on the commoditization of renal care delivery. They have built a universally applicable franchise that thrives by solving the healthcare industry's most expensive logistical headaches.